Hello, welcome. Thank you so much for joining us for SVN Capital's Q2 conference call. It's great to have some of our LPs as well as prospective investors joining us live. As many of you know, SVN portfolio manager Shree Viswanathan focuses on finding and making concentrated investments in compounders and special situations across global markets. His investment criteria and research approach is informed by his extensive background as an M&A banker, a corporate development executive in a commercial bank, as well as a portfolio manager and analyst for large investment firms, including Keeley Asset Management, Discovery Financial Partners, and Advisory Research. Before I hand things over to Shree, I want to mention just a few housekeeping items. First, this presentation is for informational purposes only. It is not intended to constitute a sale, solicitation, or advice. Accredited investors wishing to learn more about SVN Capital should reach out to me separately. And after Shree's presentation, we will open it up for questions and answers. You are welcome to submit a question through the chat feature, and I can voice it, or you can raise your hand so that I can unmute you to ask your question live. Once again, we thank you for joining us, and now I will hand it over to Shree.
Thanks a lot, Jessica. Hello, everyone. Good morning, and thank you all for joining me and Jessica here today. It's about a month since I released my mid-year letter, so I thought it would be a good time to get on the horn and answer some of the questions and concerns people may have. I'll present my prepared remarks over the next 20 minutes or so. I would encourage you to ask questions about the market, portfolio, and I'll try and answer them as best as I can. As Jessica mentioned, I want to be respectful of your time. And so we'll wrap this call up in about an hour, but I would be available and happy to talk to you beginning tomorrow. So over the last few months or so, there are these three questions that have come up frequently in my conversation with investors and other managers. Impact of inflation, impact on our stocks, and is it a good time to be invested? Now, before I get started, let me quickly review the investment criteria. Essentially, before I pull the trigger on any investment, I need an affirmative answer on these four questions. Is it a business that I can understand? Is it a business that generates high return on incremental capital? Does it have great reinvestment opportunities? Is it run by quality management teams with skin in the game? I prefer owner-operators. And finally, is it available at a reasonable valuation? Currently, I own 10 businesses. I'm not constrained by geography or size of the company. Although with a couple of self-imposed constraints, I end up with reasonably liquid opportunities in North America and Europe. I'm interested in companies that are growing fast and are highly profitable now. Over the last couple of years, particularly post-COVID, several bubbles formed around technology companies, SPACs or special purpose acquisition companies, and cryptos. Now, many of these stocks did incredibly well. Most of them were fast growers, but were not making money. They were burning cash. Now, they may or may not make money for in the future, but given my investment criteria, I've avoided those. Many of them are now coming home to roost. And so the first question is, what's the impact of inflation? Now, everywhere we turn, every page we turn in a financial newspaper or a magazine, we can't help but get reminded that we are at a 40-year high in terms of inflation. Last time inflation was this high was in 1981. While that may be very similar to 1981, some of the important variables are not. Now let's look at this chart. This is essentially consumer price index, which is in light blue, starting from 1980. And then the dark blue is actually the Fed funds rate. The vertical shaded areas are the recession periods. Apart from inflation being similar to 1981, a few other things that were similar are, oil prices were surging just like today. The Fed was tightening its monetary policy just like today. People were concerned about the economy and investors were jittery, just like today. But a couple of major differences, and they matter, a couple of major differences. Number one, back in 1981, interest rates were far above the inflation rate. 10-year Treasury, for example, was approximately 13%, while inflation was a little more than 9%. Mortgage rates, as a result, was 17%. As you can tell, even with the most recent rate increase over the last few days, inflation is a lot higher than interest rate today, meaning the real rate is still negative. So that's an important difference. Second important difference is unemployment. Unemployment rate back in 1981 started surging and it hit almost 11% by 1982. Unemployment now is only 3.5%, with almost 2 jobs available for every open position, or 2 positions available for every applicant. So what's the major takeaway? There are actually, I think, 3 major takeaways. First, the consumer, who makes up approximately 70% of GDP, is in a much better position relative to the past, and is probably better placed to handle this recession. Second, the question during an inflationary period is, does the business have any pricing power? Gross margin is the best predictor of pricing power. Gross margin of our portfolio companies is approximately 60%, while for S&P 500, for example, is only 40%. In other words, our portfolio is better positioned to handle any inflationary pressures. Third, in an increasing rate environment, businesses with financial leverage or business models that rely on financial leverage, they face even more headwinds. Our portfolio companies hardly have any debt. In fact, many of them have net cash on the balance sheet. Some pundits today are saying inflation is here to stay. My reaction is perhaps so. But if we partner up with honest, competent management teams in owning high quality businesses that have pricing power, in the long run, this current inflationary pressure may not necessarily matter. So the second question, what's the impact on our stocks? Before jumping in to talk about a few of our portfolio companies and show you why I remain optimistic about our portfolio, I want to talk about the 3 drivers of any publicly traded stock. It's essentially free cash flow and its growth, market multiple on such free cash flow, and dividend yield. Free cash is the source of the 2 primary drivers of intrinsic value of any business. Return on incremental capital and reinvestment. Both metrics remain very healthy for our portfolio companies. Over the last 6 to 7 months, market multiples on many of these businesses have come down dramatically. For several reasons: the war in Ukraine, inflation scare, interest rate increase, energy price spike. But my point is, if the businesses continue to remain healthy without any debt on their balance sheet, generate high return on incremental capital, and have terrific opportunities to reinvest, over the long term, we will reap the rewards. Let me show you with a few examples here. First up is Evolution. Now, this is the Swedish company that's the world leader in providing live casino infrastructure to gaming operators like DraftKings and FanDuel. On a global scale, there are only a handful of companies that offer such services. Evolution is the largest and has more than 70% market share. The business continues to grow at a healthy pace, 34% revenue growth in the most recent quarter. While Europe is a mature market in this area, North America, particularly the US and Asia, offer fantastic growth opportunities. There's no debt on the balance sheet. The business continues to double almost every 18 to 24 months, generates really high returns, high margins. This is a layout of its historical performance. I know the page is a little busy, but focus on the column on the far right, which says compounded annual growth rate 9 years. And the last but one line from the bottom that's shaded, that's free cash flow over invested capital. First, the compounded annual growth rate. Now, revenue has compounded at almost 45%. Operating income has compounded at 57%. This essentially means that for every euro of revenue, company generates more than €1 of operating income and free cash. This is what is called as a company having good operating leverage. Now, cash return on capital is approximately 20%. In other words, the company is very healthy and is operating at terrific rate. The founders are on the board. They own 11% of this 20 billion market cap company. And yet valuations have become a lot more attractive, particularly over the last few months. At current price, this company is trading at less than 20 times earnings, 17 times free cash. Next up is Old Dominion Freight Line. This is the only company added to the portfolio in 2022. Now, there are two major types of trucking companies. Truckload is the first type, where a shipper will fill up the truck and the driver will go from, say, New York to LA. There are lots of inefficiencies in that model, driver attrition being the first casualty in that. The second model is the less than truckload, or LTL, where not one but many shippers will, in a particular area, will load up the truck. And operators like Old Dominion or ODFL, they consolidate these small shipments. These are typically 150 pounds to 15,000 pounds in a service center, similar to a hub and spoke model. But by design, these are capital intensive and logistics heavy operations with a need for having well-located service centers. While there are thousands of trucking companies, the top 10 LTL, less than truckload carriers, they control about 70% of the business. And many of them are small operators that run less than 10 trucks. But ODFL is the second biggest in this area, second biggest in terms of market share, second only to FedEx Freight. The company had a terrific Q2, 26% revenue growth. And more importantly, it's the most efficient operator in the entire space. Operating ratio, an industry metric, which is essentially operating cost over revenue, was 69.5%. The first time in the company's history to be below 70. The rest of the industry operates at well north of 80%. Business generates very high return on capital. Like one of our other portfolio holdings, Copart, Old Dominion's primary target for capital deployment is opening up new service centers. It currently has 255, but has plans to open another 35 to 40 over time. It owns the land on which these service centers sit. And that's an effective inflation hedge. A similar table laying out the historical financial performance. Again, focus on the far right and the second line from the bottom. compounded annual growth rate of 12%, operating income at 21%. Again, very healthy operating leverage. Cash return on capital in the 20 to 30% range. The founding family, the Congdons, they own 18% of the company. They're on the board. Again, it's a company that's trading at a very attractive valuation, particularly when you consider that e-commerce, which relies on less than truckload, is growing at a much faster clip than traditional retail. And the last name that I want to highlight is our Polish, fastest growing Polish retailer, Dino Polska. Now, the company focuses its operations in rural and small town Poland, where its competition is limited. Unlike most developed and even developing countries, more people live in rural Poland than in urban areas. That plays very nicely into Dino's strategy of focusing on those geographies. Now, back in 2010, the company had only 110 stores. They just announced the number of stores as of 6/30. It's almost 2,000. That's a compounded annual growth rate of 30%, an incredible growth for a retailer. These stores are highly profitable, generating more than 25% return on capital. The founder, who's only 47 years old, Tomasz Biernacki, has astutely decided to reinvest every zloty back into opening new stores. Like Old Dominion and Copart, Dino also owns the land on which these stores stand. So again, a good inflation hedge. In any retail operation, one of the most important metrics is like for like, or same store sales. Dino's largest local competitor is a company called Biedronka, which just announced its Q2 numbers last week. Biedronka, for the first time, put up like for like of more than 20%. Dino is yet to announce, but historically they've done exceedingly better than the rest of its competitors. I expect Dino to continue to grow at a breakneck speed. Another page on the layout of its historical performance. Now, while the company was founded in the late 90s, it's been public only for a few years, and so we have only a limited financial history as far as Dino is concerned. But what we have shows a strong operator, astute capital allocator, and significant growth opportunities. And that leads me to the final question. Is it a good time to be invested? I say absolutely yes. It's true that you don't want to ask a barber if you need a haircut. Given my hairstyle, I don't either. Equity investing is a never-ending emotional battle between fear of the future and faith in the future. I'm not going to rattle off all the fear factors that have popped up over the last 6 months. I hope I've shown you with a few examples from our portfolio as to why I remain optimistic about our businesses. Now, this is a chart from Bank of America Research. This chart essentially shows how the so-called professional money managers have become so bearish on the stock market that they have increased the level of cash to more than what it was back in 2008. That just stands out as being ultra pessimistic, particularly for long-term investors. And this is a fascinating chart about why time in the market is more important than timing the market. It shows how remaining fully invested in, say, S&P 500 over the last 20 years would have yielded about 9.4%. But just missing the 10 best days in the market would have cut the returns by almost half to only 5.2. And then that starts declining rapidly once you start missing 20 or 30 best days in the market. But the most interesting stat in this chart is 7 of the 10 best days occurred within 15 days of the 10 worst days. We had almost 10 worst days in middle of June. I had included this chart in my mid-year letter, but it's worth highlighting again, I think. This is a chart from JP Morgan Wealth Management. It shows all the reasons by year to not invest in the market. For example, 1999, there was fear about Y2K. 2000 was a fear about the tech bubble bursting. 2001 was 9/11, and so on and so forth. But look at that gray line slowly inching to the right and to the top. Now, the advance is permanent, the declines are temporary. As an aside, it's kind of funny that the author couldn't find a good reason for 2006. The point is, not only is it a good time to be invested, but it's a great time to be adding more. To those that are sitting on cash, my question is, what are we waiting for? My final chart is a layout of how the market has performed 1 year, 3 years, and 5 years after some of the worst years in the market. The takeaway is the longer we remain invested, the better. And so in summary, impact of inflation, I say over the long term, little to none for this high quality portfolio. Impact on our stocks, the passage of time leaches away the risk, leaving a premium return for us. Then finally, is it a good time to be invested? I quote the great Jack Bogle. Stock market is a giant distraction to the business of investing. Now with that, let me stop and see if there are any questions. Thank you.
Thank you, Shree. As a reminder, we'll go ahead and open it up to questions. Feel free to raise your hand to do so. If you just toggle over the reactions icon in your screen, you can raise your hand, ask a question live, and I can unmute you. Or you can submit a question in the chat feature, through the chat feature. So while we give a minute to everybody that would like to submit a question, we did, Shree, have a couple questions that came in from some LPs that regrettably couldn't join us today. So let me throw those out first. So Shree, if certain countries ban online gaming within their borders, what will be the impact on Evolution?
Yeah, that's a good question. Actually, it's happening and it has already happened. As I said, Evolution is a global leader in providing live casino infrastructure. Even though Europe has been relatively mature, some of these countries in Europe, for example, Germany, Netherlands, and even UK more recently, have shut down their operations, their live operations for a little while, to either fix the regulatory environment to control the future operating environment for these gaming providers, or to reevaluate if they really want to continue to allow such live casino operators to exist. And in spite of those types of stops and starts, Evolution has put up the kind of numbers that I showed. So it's an ongoing evolution. Yes, countries will reevaluate. Canada, for example, stopped live casino for a little while to get ready to get its operations in order with respect to its local lottery systems. But in early April, they restarted live casino games, and Evolution has been very active providing its infrastructure to many operators there. So yes, that will continue to happen. But my takeaway is, in spite of such developments, Evolution continues to not just exist, but thrive.
Great. We did have another question on another portfolio holding that you didn't mention, Could you speak to how strong the competitive advantage of live chat software is, and maybe give a little bit of background on live chat?
Sure. So yeah, this is another Polish portfolio holding. It's based in Southwest Poland. It's a software company that provides customer communication applications. So for example, when you go to certain websites, you may see a pop-up on the right bottom, which may ask, how may I help you? Or how may I direct your inquiry, and things like that. Live chat is one of the companies that provides that, that app, that sort of an application. There are a number of other providers. There are actually some what are called as freemium providers, essentially give away that feature. But there are a few premium providers as well, including live chat. The freemium providers are not really true competition for somebody like live chat. The reason why I say that, and the reason why the company says that is, for example, a large law firm or a financial institution or any major business entity may want to protect its data, keep its customer data under wraps. And when they go through a freemium product, that sort of protection is usually not available. And so it's premium providers that are true competitors. As I said, this is a Polish company, and many of its premium providing competitors are here in the US. The gentleman may have heard of a company called Zendesk. It's a European company that sort of transplanted itself here in the US, a company called HubSpot. The oldest in that space is a company called LivePerson. The most recent one that went public is actually an Indian company called Freshworks. The reason why I bring up all these competitors is none of them make money. They're burning through cash. Their SG&A, selling, general, and administrative cost, relative to their revenue, runs into well north of 60+%, essentially eating into any potential returns. While live chat's SG&A margin is barely 22, 23%. Highly profitable, highly cash generated. Not only that, many of these competitors, because of their poor performance, have had their stocks hit hard, 60, 70+%. Activist investors have taken, have rattled the cage. LivePerson, for example, has an activist on its board. Zendesk, which was a public company, actually rejected an offer at $17 billion in February this year. And just a few weeks ago, was forced to accept a $10 billion offer to be acquired by a couple of private equity firms. And so, yeah, the competitive landscape continues to remain in shambles. Moat relative to, say, for example, an Evolution or a Copart is definitely a little lighter, given that there are other competitors in the space. But the company continues to put up increasing fee-paying customer base, generating better returns, and returning almost 100% of its cash back as dividend. The current dividend yield on the stock is north of 4.5%. So it's a highly profitable company. The founders are running the company, the CEO and the founder own about 47% of the company, no debt, and increasing operating performance and increasing returns back to investors.
Sorry about that. Thanks, Shree. And just for everybody's benefit, for any of the companies that you've spoken about that you might have written more extensively on, I'd be happy to share any information, any of the papers that you've produced in the past after the event. The next question is a twofold one, Shree. You mentioned that Old Dominion Freight Line was the only company that you added in 2022. Would love to know why. And then kind of piggybacking on that, given the current state of increasing interest rates, inflation, are you making any changes within the portfolio now? Or have you in the recent past?
Yeah, so the only change that I've made is add Old Dominion to the portfolio. And the reason why that is the only change is because this is a company that I have followed for a little while. And that's how these things typically happen for me. They tend to marinate in the background for a little while. It could be a price decline. In this case, the stock started coming down once the inflationary pressures and recession fears started increasing. That could be a reason, or sometimes it's a change in management team or some other acquisition. Could be a variety of different reasons why a particular stock becomes more interesting and appealing. But typically they tend to sort of marinate in the background for a little while. But Old Dominion is a company that I've followed for a little while, some of the other peripheral companies as well. And as I mentioned in this case, because of some of the macro factors, the stock started becoming a lot more attractive. And it kept actually going down as I started building a position. Typically, I think about a full position in the portfolio at approximately 10%. And there is no one specific methodology that I embrace in terms of developing a full weight. I started slow and eventually got to a point where it is today, which is approximately 9%. So any other macro factors that are impacting the portfolio today? Not really. I'm not a top-down investor, meaning I don't necessarily take interest rate as a driver or some sort of a recessionary fear as a driver in making a portfolio decision. What I typically do is look for bottom-up analysis. Is it I ran through the 4 questions that I typically look for. Is it a company that I can understand? Is it generating healthy returns, and does it have good reinvestment opportunities? Is it run by good quality management teams, and is it available at a reasonable valuation? So I remain consistent to those 4 questions, whether it's an opportunity here in the US or somewhere outside. Macro factors, I don't ignore them, but they don't necessarily drive as to why and how I make a portfolio decision.
Thank you. I think, Paul, did you want to ask a question?
Yeah, am I unmuted now?
You are, thank
Oh,
you.
Okay, yeah, my question was, I know, Shree, you like to build the portfolio of compounders, and occasionally you'll have a compounder and it'll appreciate over what you think the current intrinsic value is of that compounder. And then, so the question is, what is your thinking about when is it okay to sell a compounder? If you still believe in it for the long term, you still believe in its ability to increase its intrinsic value over time, is it ever okay to sell a compounder? And what is your thinking about that?
Yeah, selling a particular stock from the portfolio is the more difficult decision than buying a particular stock, particularly when we're talking about compounders. These are businesses that are generating healthy returns with clean balance sheet and good management teams. It's very difficult to come across businesses like that very often. The SEER, the filter that I use to arrive at these companies is pretty tight. And as a result, the selling decision requires and demands a lot more thinking. It's not necessarily just based on valuation, particularly if I end up making sell decisions based on valuations on these high quality compounders. I've realized that over time, looking back, it would have been a mistake. And so there is no, and I'm not going to be able to give you a very specific answer as to what methodology to follow, but historically, making a sell decision on these compounders, unless they're incredibly expensive, some of these high quality companies, along with all these money losing, cash burning companies, ran up incredibly post COVID. Fortunately, I was not at the point where I'd ramped up the full weight. And so I didn't have to go through this decision at that point. But it's a very important point that I wrestle with all the time. But bringing it back to where we are today, I think the entire portfolio is incredibly attractive. Before I get to the point where it becomes a difficult decision, I think it would be important to highlight how attractive this portfolio is today. But I'm not going to be able to answer a specific methodology for you to follow in terms of sell decisions, because they are by nature more difficult than buying.
Thanks for that question and that answer. I think we have one more, Shree. Again, what sort of investments do you find interesting in this current environment? And what sort of investments would you typically stay away from? Are you staying away from?
Yeah, I can answer from the latter part of that question. I always think about describing the portfolio as how Michelangelo answered the question about how did he create David. Well, he said, I just took this large piece of rock and removed all the unwanted pieces. I kind of think about avoiding some of the sectors that don't necessarily fit my criteria or areas that I'm not familiar with. For example, in this most recent 6-month period, the one sector that has done exceptionally well is energy. Any type of oil and gas business has done exceedingly well, although they've pulled back a little bit more recently. But that's an area that I completely avoid. I've never spent any time. Now, for all the different 11 sectors, financials and energy are the two sectors that require different type of analysis. I've spent a lot of time on financials, and I'm staying away from those as well. We'll come back to that. But energy is an area that I've never spent time on. And fortunately, it's also an area that doesn't necessarily make true returns for investors over the long term. There is a Bloomberg Energy Index that goes back to 1991. And from 1991 till 2022, including the most recent run-up, of course, the total return from that index is less than 1%. That's how incredibly unprofitable that sector has been. Of course, there are individual opportunities. For example, Warren Buffett has been ramping up on Occidental or XY. There are incredible opportunities within that sector. But for me, if we can focus our portfolio on these very unique, interesting compounders that fit my primary criteria of understanding the business, I would happily give up on these types of energy, oil and gas exploration type of companies. The other sector is that I would avoid is financials. Even though I've spent a lot of time in financials, at this point, even though interest rates have gone up a little bit, they're still at a historical low. As I mentioned, in 1981, inflation was north of 13% or north of 9%, and interest rates were more than 13%. We're talking about 10-year treasury that went from almost 50 basis points in COVID to a little north of 340 basis points, and now pulled back to close to 260, 270. It's still at a historical low. Typically, any financial, a bank, mostly banks, real estate investment trusts, business development companies, specialty finance, all these are highly levered balance sheets, meaning they maintain a level of debt that's a lot higher than what our portfolio currently carries. And generally speaking, when rates are low, when debt capital markets or some kind of debt financing is available freely, the market is willing and able to pay only a slight premium to that cost of debt, meaning the return opportunities in these types of levered balance sheets is not that great. So I avoid those. And of course, as I mentioned, any type of non-energy, non-financial businesses that rely on debt or that have a lot of debt, I would avoid those. So, sticking to those limited number of businesses, limited number of sectors, and getting to know the management teams, getting to know the intricacies of the industry, that's what I tend to focus on. The most recent one, as I mentioned, is ODFL. It's a simple business. There are thousands of competitors, but as I mentioned, there are only a limited number of companies that control a majority of the entire opportunity set. And Fred Smith, before he stepped down from FedEx on an earnings call, actually called out and said, yes, we have a LTL business within FedEx, but the best out there is a company called Old Dominion. And I mean, I thought that's incredible validation by a competitor, as far as ODFL is concerned. That sort of shows how the business has been operating, quality of the management team, returns, as I mentioned, are relatively healthy and high, clean balance sheet. So those are the types of businesses that I gravitate towards. I'm working on a couple right now, one particularly in Europe. I don't know if I'm going to be able to pull the trigger, but that's the kind of feature that I prefer.
Fantastic. Well, it looks like that does it for the questions. Really appreciate your insights on this call. Really appreciate everyone joining us live. We'll be sharing a recording post-event, and we hope it's been informative. We do look forward to any future conversations with you and hope to offer opportunities like this in the future. And as I mentioned, if you'd like to learn more about the partnership, the portfolio, or just talk to Shree directly, please, feel free to reach out and we'd be happy to connect. So many thanks for joining us, and we hope you have a great day.
Absolutely. Thanks a lot, everyone.